Welcome, YouTubers. I'm Tony Mendes. Today we are talking about changing your loan term in a refinance. Welcome back. I'm Tony Mendes, host of the Real Estate Report radio show, mortgage expert, been in the business over 17 years. Today we're talking about changing your loan term during a refinance. Some of the topics we're going to hit today include paying your house off early, saving interest, retiring, duplicating your loan term in what they call a flex loan, qualifying and self-amortizing. These are some of the things we're going to hit today, but let's get through some of the myths that people have. Number one, you do not have to get a 10, 15, 20, or 30-year fixed. You can get any loan term between 10 and 30. You can get a 17-year or a 23-year loan to fit a time frame or to fit a certain budget. And number two, you don't have to shorten your term when you change your term. You can extend your term. A lot of people that are retiring, they didn't quite get their house paid off in time. They extend their term. Reamortizing lowers their payment, even if their interest rate goes up. But they want that payment going into retirement because they're on a fixed income, and they fear that they might not qualify later to get the money out, so they just do it now. And then there's investors. Investors like reamortizing often. They like to either take cash out, reamortize. Let's say you can get $100,000 out, reamortize and keep your payment the same. Your cash flows stay the same, but now you have $100,000 in your pocket. So you have a lot of people that use changing your term to fit timeline goals as well as financial goals. The big one is going to be saving money on interest. That's what most people recognize when they say changing their term, because they think they're going to shorten their term, which also lowers their interest rate, and it also lowers how many years they pay interest. So they can pay a lot less interest. Let's take, for example, a $500,000 loan at 3.5%. You're going to pay about $371,000 in interest, whereas if it was a 15-year, you're going to pay $177,000. So it's about 50% less. So you can see the power of the shorter term. I mean, these are front-loaded interest loans. So you want to shorten that term as much as possible and lower that interest rate if you can. Paying off your house by a certain date. That's another thing that we see a lot of people do. They want to set let's say I want to retire in 18 years. So they get an 18-year loan or a 20-year loan and have a couple of years in retirement where they have a payment, but after that they don't. So we just don't want you to pay off the house and then not have any retirement, because once that money is locked into that equity, it costs money, number one, to get it out. You still have to qualify to get it out, and it's cheaper to have a loan to begin with. So if you can't pay off your house by the time you retire, a lot of people actually keep a mortgage. They actually refinance, which is where we go with the retiring. A lot of people that retire simply just say, you know what, I'm not going to pay off my house by the time I retire, but I'm making money now. I can qualify for a loan. I may not qualify later. Rates fit where I need it to fit, and I'll have a good budget. I'm just going to refinance into a 30-year. That's where extending your term can really help you, especially if you are looking at a fixed income or a variable income that you just don't know what it's going to be. Now, you just didn't think you weren't going to pay off the house, and you wanted to, but you just didn't quite make it. A lot of people don't. My dad didn't. My dad carried a $150,000 mortgage into his retirement, but his payment, he refinanced right when he got into retirement, and his payment was only $650 or something like that. It doesn't have to always work for you, but that's the power of the mortgage. That's the power of changing your term to fit your financial goals. We talked about retiring. A lot of people, before they retire, be careful. When you're on a fixed income and maybe you don't have Social Security yet, you have to worry about qualifying coming into that into retirement. If you haven't reamortized or refinanced before going into retirement, so double check first, because if you need that money later, you don't want to do it after you retire. You want to do it while you're still making money and while you qualify. So the flex term loan is something that's very interesting that a lot of people don't talk about. Again, that's one of the myths we busted earlier. You don't have to get a 15-year or 30. You can get any loan term between 10 and 30. So you can take let's say that you want a 25-year loan. A lot of people that are refinancing, they take they've been in the loan for 5 years, and they say, I don't want to reamortize for 30. I'm going to get a 25-year loan. So they do another 25-year loan. They might be taking some cash out, or maybe they're just lowering their interest rate, or both, but they're getting that 25-year loan because that's what they had before. They don't want to go to 30 years. They're already on a timeline. The flex loan also works in the other way around. Let's say you have a payment target. For example, if you want an $1,800 payment on a $300,000 loan, that equates out at, I think 3.5 I took for this number, at a 19-year term. So you just simply get a 19-year term. It fits your budget for however long that you want it for. And that's the beauty of that flexible loan term. So on a couple other notes, qualifying, remember that the lower interest rate with the shorter term most likely is going to have a higher payment, and you still have to qualify for that. So qualifying is the key here when you shorten your term. Extend your term. A lot of people actually extend their term because they don't qualify for the shorter terms. That's the benefit of that refinance and reamortizing. And then self-amortizing. I like this one. I self-amortized on my property. One of my rental properties that I have, I simply did biweekly payments. That's the most popular way to self-amortize. It knocked off several years of my loan. And next thing you know, I was like, hey, I only had 10 years left. And then it was like 7, and it got shorter and shorter. But you can do that. You can self-amortize to whatever goal that you want. Let's say you want to do it in 22 years. You can say, how much do I need to pay? A lot of people do the self-amortizing because they don't want to get locked into, let's say, a 15-year payment. Let's say that payment's $3,000, but the payment for a 30-year fix is $1,500. So they'd rather fall back on that $1,500 instead of making that $3,000 payment all the time. They just make it every once in a while. So it's another kind of a self-preservation mode, but you still accomplish what you want, and that's to self-amortize and pay off that mortgage as soon as possible. If you have any questions, you can always reach out to us at bayarealoansource.com. You can set an appointment with our link right here, as well as sign up for our other videos by subscribing. Thanks for joining us today. Again, I'm Tony Mendes, host of the Real Estate Report radio show. We'll talk soon.